Joining us tonight are Dan Patton, who is a senior mortgage agent and director of sales with Better Mortgage Select, and Andrew Signa, who is a partner at the Above All Realty Group. We are talking about residential and commercial real estate at this point. Both are real estate investors. Both people are real estate investors. They have a deep understanding of the real estate market, and they have a lot of expertise in their relative respective areas, specialties, and that means that they're pretty valuable people because they're the people that we go to get answers from. So tonight, we're going to be talking about how you deal with interest rates, whether they go up or down. Right now, they're going down. The planning that you have to do, the implications that it has for everyone, and we'll just take it from there. So. We will have a Q&A session at the end of the segment, unless we don't have too many questions. Don't forget, when you put questions in, please put a Q in the chat and tell us who you would like the question directed to. That would be really helpful. And also make sure that it's set to everyone so everyone can see your question. All right, here we go. Dan, Andrew, interest rates, they went down. Not by much. It was like a little nudge down, right? Just a little one. What was your first thought, Dan?
Expected, I think. It's funny because I think if you had asked me at the beginning of the year, do I think a rate cut in the middle of the year in the summer, June or May would be possible? I would have said no. I really didn't think that was going to be possible. But I think as the year sort of progressed, it became more and more likely and more obvious to us that they were going to have to do something. It was either coming June or July. I mean, if you're looking at the signals that they're telling us they're looking at, things like CPI, unemployment is another thing we're monitoring. But if you're looking at all these things, you're realizing that our economy maybe isn't in the best position. And if they don't start making these changes now, I mean, you could argue it's already too late for a lot of Canadians. But if we don't start making these changes now, we're going to be in an even worse position. So I think it was inevitable. A quarter point, you're right. It's not amazing, but I think we'll see another one in July or September. One between those two. There's no rate announcement in August, so we skip that month. But I think we'll see another one in those 2 months. I don't think there's any point in keeping them high anymore. I really don't. I think that it's killing the economy. So I think it's just about time that they start lowering it.
Because they've been talking, well, I remember a year ago driving in my car and listening to something on the radio about, there were economists talking about this, and it's like, oh no, we're going to keep interest rates up. We have to keep interest rates up because of this, and this, and don't expect interest rates to go down. It was like, literally, they were saying for years. Mind you, I do know that if you get 10 economists in a room and you ask them the same question, you're going to get 10 different answers.
100%. 100%. It's like the weatherman, you know what I mean? It's like just sunny with a chance of rain. But yeah,
right.
You were getting a lot of different views, but yeah, I mean, it's good news. It's good news for us in the sense that rates are, finally seem to have been peaking. At least sentiment's changed. Nobody's sitting around waiting for rates to stop going up. Everybody's just sitting waiting for rates to start going down now. So that mental change is important in the housing market anyways.
Yeah, so what I noticed is that there's now a lot of more buyer confidence, which is obviously good, but I'm kind of teeter-tottering. Like, I don't know if it's a good thing or a bad thing. I do think housing is extremely high, and the interest rates high are bringing it down, which was, more affordable, which I like to see the prices come down a bit. But the problem is like Daniel said, a lot of people are feeling the pinch, and movement needs to happen in the economy. And what that's going to start to do is really start getting people spending again. And Daniel, I know that you've probably seen this way more than I have, is that people are now going, hey, what's my property worth to refinance? Or what can I buy? Or now it's building that buyer confidence for people to kind of come out of the woodworks. Because before it was just everybody was very hesitant. They're like, well, what's going to happen? We don't know if it's going down or going up. Now that the first little nugget showing that it's going to go down, now more and more showings are happening. Like, I submitted an offer and there was 22 other offers on offer presentation day. So it's coming, which is the disappointing part of it going down. Is now prices for housing is going to go back up. Now in the commercial world, not much has changed, and people are really really hesitant in the commercial world because of vacancy rates, right? Depending on what asset class you're looking at, like what I was looking at some data, which was really, really interesting, is that office space is at an all-time low, right? So, but top tier office space is at an all-time high. So AAA tenants that are renting office spaces are through the roof, which means landlords are going to actually need to step up their game to provide a product that is actually worthwhile for a commercial tenant.
So wait a minute, you cut off just a little bit there. I didn't hear you properly, Andrew. So you're saying that AAA tenants, so Class A space, I guess is what it's called, right?
Yeah, yeah.
There's a lot of it on the market?
No, there's less of it on the market.
Oh, there's less.
That's
Oh, okay.
less of it. So what like A tenants like big banks and big tech companies are coming into Toronto left, right, and center. So the spaces are getting occupied quite quickly. And now I think there was a 3% vacancy rate, I think I was seeing one on the report, which is unbelievable because everybody's like, oh, office is dying. It's like, no, core office space is dying. So what it's going to do is make commercial landlords step up their game to provide a good product.
Okay. So commercial landlords to take advantage of it then need to be improving the quality of their offering so that they can take advantage of the demand for AAA tenants.
Yeah, because the interest rate's going down. It was going to happen regardless. But I know like big boy investors wanted it to stay high because purchase price is coming down. Because you make money on real estate on the buy, right? The lower it is, if you hit the right peak on the buy, in a year or two, that same asset just gained 20%. Daniel would probably see that more on the lending side than I would. But if someone buys at the right time and appreciation happens, you could pull out a good portion of your equity just from the buying at the right time of the interest rate.
Oh yeah, we definitely saw that. And when peak COVID, when rates were at their all-time low, multiple offers, you're right, you were seeing properties go up 6 figures in a year, less than a year in some cases.
Yeah, so my feeling is we're not going to see that now. I mean, first of all, a quarter point, I mean, that's nothing really. And it's an indication perhaps that interest rates are softening. I think too, also we have to keep in mind that our neighbors to the south are making changes to their interest rates, and we do have to be competitive to a certain degree, correct? I mean, money's going to flow across the border faster than anything if we can't supply the financing to people who want to invest in real estate. Oh, it makes sense.
What's actually interesting about that is I heard that about $400 million left Canada and went to the US the day from the announcement of the capital gain tax to I believe the end of May. $400 million left Canada and went to the United States, which is very concerning. And there's no data that I actually read, but this is what I heard. And if that is even half correct, there's a massive problem.
Well, yeah. When we could spend a lot of time talking about the capital gains tax too, but everything is going to work together here, interest rates and capital gains and all the rest of it. So let's get back to the interest rate. So Dan, when people are coming to you and they're saying, okay, I want to invest in a property, maybe it's 1 or 2 units, I don't know. And what are you telling them now? Is it a good time, a bad time? Are you telling them to hold and wait?
Yeah, a really good question. So I think it's at any point in the market, when the market's hot, when the market's slow, I mean, it's always a time to be strategic. So I think for now, what I tell people is, listen, if I had the opportunity to buy real estate at a time where prices were high and interest rates were low versus prices being down a bit and interest rates high, I'd rather buy at this point when rates are higher and prices are here. And one of the main reasons, if we're sitting at a time where we think interest rates are going to come down, then that will change. Your interest rate will come down as the price of the home goes up. And that creates an interesting time for anyone buying a property because market conditions are way different, right? I think Andrew would probably tell me it's crazy because on one hand, he's absolutely right. I hear all the time people are like, holy cow, 10, 15 offers, 20 offers. But I'm also seeing way more situations right now where clients have purchased a home with the intent of selling their existing home, and their existing home isn't selling necessarily. Now that might be because they're overpriced, and in this market you really have to be, you really have to know your values and understand, the transaction costs. But it's just a weird market. It's volatile. It can go either direction. It can be super busy one week and then dead the next week. So you have to be very cautious in a time like this. But that creates a lot of opportunity for somebody buying. This is that time where, anybody who hasn't been in the market the last 10, 15 years hasn't seen what a power balance the owner of the home, the sellers, had versus the buyer. The supply and demand has just favored the seller for 10, 15, probably 20 years. We had a little bit of a blip in like 2017 and maybe in 2008, but it didn't last. Like the prices just went up the very next year. So now is just an interesting time because that power dynamic seems to have shifted to more, I'm not saying completely, but more of a buyer's market in some opportunities. So that just creates a strategic time to buy. So I think it's a good time to buy if you're being strategic. If you're working with the right people, you may find opportunities.
Yeah, I'm just trying to reconcile like everything that I'm hearing here because we're saying multiple offers on properties. Now, if you're an investor, it's one thing if you're buying it to move in for yourself, your own home. That's a whole different ball game, right? Because now you're looking at long term and but investors look at well, cash flow for one thing. They also look at exit strategies right away. Most people when they buy a home do not look at exit strategies. They really don't, right? That's not what happens. So buyers for real estate investment are looking at exit strategies. So you've got on one hand, you've got all these offers on properties that investors might be interested in. So that might be forcing values, or I should say value, I guess the value up, the price up, whether the value's up, that's a different statement question. So you got prices up. Investors going after the properties that are available because there hasn't been much on the market, really, has there, for anyone over the last little while, right? Andrew, you know more about that than I would.
Well, it depends on what you're looking for, right? But right now, a lot of smaller multifamily, like I'm talking about duplexes, triplexes, quads, they're not moving because it really now it's not even about the interest rates, is the RTA is making it very difficult. So people are now going, well, we have to add $10,000, $20,000 per door. So you're noticing the smaller multifamilies not moving. So there was a triplex that was in Hamilton that did not move. And it was, in my opinion, listed aggressively to sell. Did not move. It's just you're noticing people more hesitant on the multifamily side. More and more people are getting to the mindset of commercial. They rather deal with the CTA because it's more of a legally binding contractual agreement between the tenant and the landlord. It's governed by the small claims court, not a governing body that was just made up.
Sorry, and so when you say CTA, that means?
The Commercial Tenancy Act. Sorry.
Oh, okay. All right. Yeah, versus the Residential Tenancy Act. Yes, okay.
Yeah.
Okay, so I can see that. Gosh, there's so many bits and pieces to pull on here. Well, what do investors do then? Like, if you're interested in, so you can the single residential, right? Then there's a smaller multi, then there's a larger multi, and then there's the other commercial opportunity.
Asset classes.
Yeah, the other, sorry, thank you. Yes, asset classes. And if the residential is being, if there's a lot of offers on residential, that will force prices up. There's no question. It is, right? Unless everybody makes an offer and nobody can fulfill their obligations on the offer. I mean, all kinds of things, right? Maybe there's more conditional offers happening now than there used to be. Remember during COVID, there weren't, I mean, conditional offer was unheard of, right? Andrew, what do you
You
say
never,
to that?
you never put in a condition of finance. Now it's like it's a must. Everything has to have a condition because you never know how the banks are going to act, right? They have a pre-approval, but when you go get the commitment, they may be like no to the actual property. Banks are also like Daniel could speak on this. Banks are becoming a little bit more finicky and picky of who they lend money out to as well. It's not just, hey, here's money, take it. Just because you can qualify doesn't mean you will qualify.
Yeah, I
Okay,
think that
Daniel.
Andrew's speaking my language. You know, it's one thing we as investors or even home buyers um, have to understand that the banks, especially investors, like the banks are not chasing our business as investors. The banks aren't out there trying to lend people money to go buy rentals. Right? None of us have ever gone into a bank or seen a commercial or any sort of advertising from any bank in Canada saying, buy rentals and bring them to us. We love holding rentals. It's not like that. No, well, why is that? Well, to Andrew's point, the banks are a business, right? And the business of a bank is to give you a lifetime of business to get your bank accounts, your credit cards, your investments, a mortgage, an investment property. So they have product that they will offer you as a client of theirs. Now, when it comes to mortgages, you are qualifying to borrow money from a bank. That's it. They don't use common sense. And qualifying to borrow mortgage dollars breaks down into 3 criteria that we, the applicant, have to go 3 for 3 on. Okay. One, the first thing is you have to have the minimum down payment and it has to be coming from an acceptable source. That's a pretty easy one. Generally, when we're buying residential real estate, we're borrowing it from a HELOC or we're borrowing, we're using savings or something like that. So that's an easy one. Second thing's pretty easy too. You have to have good credit. The third and usually most complicated part of borrowing money is debt servicing. It's your income and how the banks see your income, which is income falls under many different categories: rental income, pension income, employment income, and how the banks calculate your income versus the debt you're qualifying for. That's literally how banks work. And if you know the ins and outs, as a mortgage broker should, of the different banks, then you know how to package the deal to get the money from them. We're just trying to unlock the door to the money. They're not aggressively chasing business. However, one thing you are seeing nowadays, which banks didn't really do before, but banks are now, if you're getting a mortgage with them, they're requesting that you open a bank account with them and have the mortgage payments come from an account within that bank. And the reason for that, they'll give you a better rate. So they'll entice you. They'll say, oh, you don't like that rate we're offering you? Well, we'll give you a lower rate, but you have to have the mortgage payments come from an account within our institution. Now, the reason for that is because the banks love having a bank account because it allows them to track a client and predict spending habits and cross-sell them product. So the part of getting a mortgage for a bank is to try to get all of your other business. So they're just trying to incentivize giving you lower rates to get your bank accounts. But that's the game we're playing. We're just trying to fit inside their box of rules to borrow the money, but they're not chasing the business at all. So we live in the world where we give them what they want. The banks want certain documents. It's not a good idea to fight them on certain documents. We give them what they want. We tell them what they want to hear so that we can continue to grow our portfolios.
Okay. Well, so where does CMHC come into all of this mix? Because as investors, yeah, this is a big one, isn't it? And again, especially in commercial, right, Andrew? Like CMHC will step in if the project is not just viable, but seems to be making money. Plus, CMHC is also a government corporation, and government policy now is to encourage more housing. So I'm flabbergasted. I just don't understand how this whole thing can be untangled because banks don't want to lend money to people who want to provide housing to other people. And of course, those people need to make money too. And yet the government's saying, we need more housing. And then CMHC says, well, hey, we got new products for you. Like go on out there and because they want to make money too and provide housing to to the nation, I'm getting breathless because there's so much going on.
Yeah, so I got a question for Daniel since we're before I left for vacation, which I'm on right now. There was an announcement from CMHC about how they govern some stuff with brokers. I didn't get the clear picture, and I'd love for you to elaborate to educate me because I actually didn't catch it before I left, and I know it came within like the first
So,
like 2 weeks ago or something.
so are you talking about the changes to their multifamily commercial? Because that's
Yes.
okay. So absolutely correct. So CMHC, just to go back a little bit for most people, that just to make sure we all understand what CMHC is. When you're buying a residential home and you have less than 20% down, the rule in Canada is the money the bank is lending you has to have insurance on it, and it protects the bank. It doesn't protect us as the borrower, it protects the bank. It's called default mortgage insurance. Anybody buying with less than 20% down is responsible for mortgage insurance. Now, when you are buying commercial multifamily, so anything that's 5 units or greater in most cases, that's not residential anymore. That falls under what's called commercial financing. Now, there's many different ways to finance multifamily commercial. One of the ways to finance multifamily commercial is through CMHC. CMHC actually will finance multifamily properties, not just residential, the commercial side. Now, CMHC has two specific divisions. One is sort of the rage that's everybody's been talking about over the last 5 years. That's the MLI program. The MLI program, in theory, allows people to go up to 95% on a commercial building. So $1 million, you can borrow up to 950 grand, and you can get up to 50-year amortizations. So this has been an insanely popular product. Now, the qualifying for this product basically revolves around the building financials, like that's always a part of it. But a lot of this product had to do with the scoring system. And the scoring system would look at the building and score it on 3 different criteria. One was accessibility. So was there, ramps and wheelchair access or elevators or things like that? Accessibility was one. 2 was rent control. So did you have, you would score points if you had, I think they had a graph of like different areas and how much you had to be under the market rent to score these points. And then they had environmental as well. So was there environmental aspects to the property? Now, through these 3 things, if you were able to score up to 100 points, then you could qualify for the 95% financing and the 50-year AM, which is super attractive to any investor because you're getting great cash flow on a 50-year amortization, and you're only putting 5% down on a multifamily building. So some of the changes, to your point, Andrew, CMHC used to have direct correspondence with mortgage brokers, where mortgage brokers like myself were able to send deals directly to CMHC. You had to be registered with them. You had to go through a vetting process, and you could deal directly with them. So one of the things that they announced is they're no longer giving direct access to mortgage brokers to deal with CMHC directly. Now, on the surface, you would say, well, that might be big news. What does that mean? Doesn't really mean anything, to be quite honest, because the broker's never really dealing with CMHC anyways. They're dealing with usually some sort of in-between lender on these projects. Like, not to get too technical, but these projects don't come up too often, to be honest. They're very tough to find. When what most people end up doing is buying a property that needs to be converted, and they try to fit it in that product, and that requires some sort of bridge in between the financing of CMHC. But CMHC, remember, is just the insurer. You still have to get a bank to lend you the money. So they took away the ability basically of brokers to go directly to CMHC on certain deals. But again, it doesn't really impact you because you have to borrow the money from the bank and you're going to the banks anyways. So that's one thing. The other change that they made, which is a lot of people are sort of groaning over, is out of those 3 things, accessibility, rent control, and environmental, Environmental was the easiest one to get the points. That was the one that nobody wants to go through the rent control, because who wants to have half the units at under market rents for the next 20 years? Like, nobody wanted to do that. So they wouldn't score points through that. Accessibility becomes expensive, right? You got to build ramps, maybe elevators, things like that. That gets expensive. So a lot of people were pushing these points through the environmental. They would make environmental changes. So CMHC recently came out and said you can only get a maximum of 50 points now through the environmental. So they're trying to force people to now use the accessibility or the rent controlled aspect of the property if you want to get those points. Now that's only for the MLI. CMHC also does non-MLI, and that, they'll still go up to 85% financing and do 40-year amortizations. But that MLI just got a lot of press the last few years, because it was new. I think it came out I think 3 years ago, I think it came out. So 2021, I think it was. Don't quote me on that, but it's relatively new. And it was exciting. We hadn't seen anything with a 50-year AM and 95% financing in a long time on the commercial side.
Well, what if you go, okay, so we're talking about CMHC and banks. Does CMHC deal with other institutions that are not banks? I'm trying to think what they might be. I mean, well, I guess private lenders are one category. How does that work? And what are the options there?
Yeah, they work with different lenders. It doesn't have to just be a bank. Yeah, sorry. Go
So
ahead.
they deal with they deal with credit unions as well, right? From my
Yeah.
understanding.
Yeah,
Awesome.
monoline lenders, credit unions, absolutely.
As an investor, I love credit unions. I think smaller the better too, because you start building that personal relationship, and it's easier to deal with, and they care about your business a little bit more than a bank. You walk into a Scotia Bank, you're just another profile. You walk into a small credit union, you're Andrew Signa. Like it is completely different dynamic, in my opinion. That's why I like dealing with smaller credit unions. Or if I do deal with a bank, I actually go to a branch and build credit or relationships with the branches that are in not the most desirable neighborhoods. Because if you go to Forest Hill or somewhere in the core of downtown Toronto, you're just another profile. But if you go in the east end of Hamilton and you're dealing as an investor and you're doing a lot of transactions, they know you. They know you by first name. And building that relationship with a bank is always a good thing.
Okay. That's actually an interesting comment, because one thing I found is you can build relationships with whoever it is, the lending agent or the manager, whatever. But you do have to be careful about not just where the branch is, but you have to look at who these people are in terms of their career. And it sounds really funny. Well, it's not really that funny, because they're looking to move up the ladder. And if they're in a poor area, or say an economically depressed area, and it's a smaller branch, they're working their ass off to get out of there to a quote better branch, right?
Yeah.
And there goes your relationship.
But like what I did was I started building relationships with even the tellers, right? Because the tellers, they also, when you remember their first names and they grow into their positions, because everybody evolves. No one wants to stay in the same position in 12 months or 24 months. So building the relationships with the people that are the future of that position, not the worst thing in the world either.
Yeah. Okay.
And being friendly to people is not really that hard.
No, it's actually way less stress than being nasty. If you're friendly,
It is. It also depends on who you tell that to.
Okay, all right. But what are the alternatives to bank? Yes, there's credit unions. What other alternatives are there?
That's got to be a Daniel question.
Private lenders, Daniel?
Private lenders. Yeah, mono lenders.
Okay.
Yeah, the general. Sorry, I didn't mean to cut you off there, Laurel.
No, that's okay. You were cutting out a little bit, so I was having a hard time hearing you. So yeah, so you're saying that like the mono lenders.
Monoline lenders. Yeah. So a monoline lender, an example of that would be like CMLS, a lender that basically offers one product, hence the term monoline, right? A bank's going to
Okay.
offer multiple product, right? Investments, HELOCs, right? Things like that. A monoline lender is basically just going to compete against banks with interest rate. That's the only product they have, mortgages and a low rate. So monoline lenders can get insurance. I mean, your tiers of lending is essentially your A lenders, which is your banks. Credit unions can certainly be in that category, and monoline lenders. Then your second tier is like your B lenders, which is alternate lending. So maybe if you're self-employed and you're not showing, enough income, or maybe if there's stress credit on the application or something like that, you could go to a B lender. And if the A lender nor the B lender works, well, then there's private lenders, and private lenders, either mix, private mortgage companies or people like, myself or yourselves that lend money to clients that are looking to, do many things, consolidate debt, build properties, renovate, things like that.
Okay. All right. Dan, are you seeing, and this is a question that came in from Lisa, are you seeing people like investors turning away from real estate right now and going more into like more traditional mutual funds and stocks and bonds and that kind of thing?
Um, I think you can get a decent return right now on like GICs, but inevitably it changes. To me, there's no better investment than real estate. That's just me. There's not. It's secure. It's a secured asset. I encourage anyone to diversify their investments. Mutual funds are great. Stocks, can be good, but they're not secured. So to me, I would be putting, if it was me, I mean, that's just me. I would just be putting most of my eggs into real estate just because I like the security. And if I look at the history of real estate, I mean, there's always times like this. There's always consolidation in the market. That's normal in any market. And the housing market is not immune to that. And we're seeing that. We're seeing the consolidation. We're seeing the squeeze of maybe people who shouldn't have bought homes the last few years, unfortunately feeling the pinch and being forced to sell. And that changes the dynamic for a short term. But inevitably, if you look at what history tells us, is the market is always resilient. The real estate market is resilient, especially in Southern Ontario. And although these times happen, the market comes back stronger. Depending on the stocks, depending on the mutual funds, depending on who your investor is. I mean, I know there's a lot of people out there that promise big returns on taking out your money, but what's more secure than real estate?
Yeah, that's true. That's true. And also, I know, Andrew, when you get into all the different asset classes with commercial, I mean, it's this stuff isn't going away. I mean, if anything from storage
Oh,
units to, like you said,
it,
Class A office space.
in a time like this, it makes that people would that point of raising rates and slowing down the market and inflation is to stop people from buying. So buying real estate today may not make sense for a lot of investors because you're going to be cash flow negative. So why put your money into something that's going to cost you money monthly? And that's why a lot of people are shifting towards GICs. You can get a decent return at a bank on a GIC for a year, probably better than what real estate's done the last 2 years, but that doesn't mean that won't change. That's all.
Yeah,
Okay.
so I just to elaborate on that point is I am seeing a lot of people kind of venture away from real estate. Like they're just very hesitant. And there's a lot of products out there that are, I'm one of them that I got appetite for, like a life insurance policy that gives you returns and protects for, if something were to happen, and you could use it and leverage it with real estate for tax benefits. So there's a lot of products out there. But on Dan's point, real estate's real estate. You can't. It's a building. You just need to make sure you buy correctly. And in my opinion, the people that are struggling now overpaid during COVID, thinking that hey, we are in the best times of our lives, not realizing that interest rates aren't going to go to zero. It's just not going to happen. Or where they're going to pay you to take debt out. It was like it's down. It's only going to go up. And people just don't understand that there's cycles. And like everything else, these interest rates are going to go down, and then they're eventually going to go back up, and then go down and then up. It's the way of the world. And if people didn't see that during COVID, those are the people that are hurting the most now. And that's kind of where it's like you bought bad, and that was just a poor investment, that you are a poor decision as an investor, and now you're feeling it. And a lot of people are like steering away from real estate. And it's like, no, real estate's still a good investment. It's a good vehicle. Shouldn't be your only vehicle, but it is still a great vehicle. Just make sure you know how to drive it.
I want to ask both of you about land development. I mean, there's a little bit off, slightly off topic, but not much because, I mean, we know that the governments, all levels of government in this country are very concerned about housing. There's a limited amount of land. But there's all kinds of conflicting interests in when you develop land. Um, but what are you seeing when it comes to people actually buying land to develop? Maybe Andrew, you could start that because you can, there's a lot of commercial stuff that goes on undeveloped land, right?
Land parcels are coming up left, right, and center, right? Because with people having harder times, a lot of developers years ago bought land and they wait, then they develop it. It's depreciation. It's a land bank, and then you either build on it or you sell it. And at the end of the day, when guys are like, okay, I have this land bank asset that now everything's getting tight and I'm losing money, what's the first one you're going to cut? Is your land bank deal. And now a lot of parcels are coming up. The problem is government doesn't allow for development of that land too fast, right? So they're implementing these new funds, like the Building Faster Fund. So every municipality has access to this fund if they hit so many starts in a calendar year. And if they go past, or if they get up to 80% of those starts, they get a portion of the fund. Now you're starting to see municipalities being like, okay, let's get permits out quicker because they're getting paid. This shouldn't have been something that took so long. Needs to be the development of land needs to be expedited because we have a housing crisis. Now with all these parcels coming up, yeah, people want to do it, but they're still nervous about what the cities are going to allow because they got their hands in everybody's business. And it's like, I don't say, hey, develop whatever the hell you want, but produce permits a little faster.
Okay. Okay. Well, as far as I am aware, there is definitely a push from at least the provincial governments down onto the municipalities to get the municipalities to issue permits faster, but also to allow the development of that land that sometimes municipalities were not allowed for whatever reason. I mean, there's all kinds of reasons, right?
Yeah.
But it's kind of interesting to watch municipalities fight a little bit. They're losing their power over that land because basically the province can come in and say, "Too bad, so sad. You got to develop it," right? But
Yeah.
again, that to the point of buying the land or financing the land, because really that's what we're talking about right now, financing and interest rates and all the rest of it. Are you seeing if more land is becoming available, are you see more people buying land even though they might be hesitant? And do the lower interest rates make it more attractive, or do the banks really care? Because sometimes banks don't really like undeveloped land. According to what
No, they don't. Majority of the time, they don't like land. The risk exposure is through the roof because if they foreclose on it, you're taking grass back, right? They look at it as like there's too much risk. But before all this turbulence of COVID, they were at 50% loan to value. And I know some banks are not even touching it; they won't even consider it, and some are still at that 50%. They're very hesitant on it. Just because inventory goes up, again, just because you can qualify doesn't mean you will qualify to get a product. It's just the way of the world. Like it's Dan can touch on this point a little bit more, but banks are very nervous. Like they have the top economists and they're still nervous.
Yeah, and the banks don't, to be honest, the banks just don't want to take on a bunch of power of sales, right? The banks, when they're lending money on mortgages, they like your cookie cutter residential homes because those are easy to sell. when you start getting into vacant land, that's such a narrow margin of buyers in the bank's eyes that the marketability of that land to have to take it on and sell it, it's too risky. It'll cost them too much money. So Andrew's right. It starts at 50%. It starts at it. But we don't see a lot of mortgages for developers, to be honest. A lot of developers self-finance. They have partners. They raise capital themselves. The timeline of getting the permit and carrying the private mortgages still at the cost, because private mortgage, on construction, you're 10%, in most cases, plus fees. So it's not cheap to carry that and wait for the permits to come in and wait to develop the property on some uncertainty still, because you have to wait for, the green light from the municipalities, from the province. It's complicated. So we see you don't see a lot of amateur developers buying it. You see a lot of professionals buying it and buying it with capital and self-financing it. That's the bulk of what we see. Most times when they're coming for financing, it's because they've run out of money in this project. That's what we see.
Okay, that makes sense actually. Because I do know people who have bought land but they got the private financing and they actually bought it. So now it's their land. And I guess in that case, if you went to develop it, you could use land as what, collateral? I don't know. Does the bank even look at that? Would they take that? No.
Not really. No.
Interesting. Okay.
No.
Oh.
They probably went to private lenders. Honestly, like if I had a client coming to me and saying, Dan, I need you to help me get financing through a bank on this vacant land, I'd be like, I can't. Like, I'd have to go private. It's so rare to get a bank to finance vacant land. And honestly, for the client, it's probably a massive headache, to the point where even private lending might be easier, a little bit more expensive, but less red tape. You got to jump through hoops with the bank.
Right. Okay. All right. Well, like you said, you take on partners and you just get a group together and you get the private money and you just do what you got to do.
Raising capital, that's a big part of it. Buy the
Yeah.
land for cash and then finance through a private lender for the build. That's, we see that. You buy it for cash and then leverage the land that you own outright through a private lender to get enough funds to do the build.
The other big thing too is VTBs with land, because VTBs, even in commercial, is being very, very prominent. It's something where the sellers need to sell for a certain amount, and it's like, okay, well, what makes it more appealing? We'll put a VTB where the debt is a little bit better. So that you're starting to see that pretty frequent on deals, especially in the commercial world, where if there isn't a VTB, it just sits forever.
Oh, really? So it's like, well, I guess it would be part of the offer process, right? We'll give you a VTB or we'll ask for a VTB, and then whatever it is, maybe it's 30%, maybe it's 50%, but still, that the vendor gets a chunk of cash, gets out basically, and still has the equity in the property, or some of it. Yeah. Okay, makes sense. All right. Does anyone have any other questions to ask Dan or Andrew on financing, lower interest rates, higher interest rates, strategy, whatever it is? I'm just looking through any questions here that we've got. Oh, there's one. When are announcements traditionally made or expected? I think you covered that, but when can you just for interest rates?
So 8 times per year, and they meet, and usually it's like June or July, to discuss when those meetings will be in the following year. But this year we've got announcements July 24th, September 6th, and then we skip November. Then we got October 23rd, and then it's December 11th. So that's the announcements for this year.
Oh, okay. So they actually
July, September, October, December.
Okay. Sounds like it's like on a 6-week schedule or something like that.
Yeah,
roughly.
about that. Yep.
Okay. Oh. I wonder why they do that. I'd really like to know what the reasoning is behind that, but I guess we'll never really know, right?
Well, I think it has to do with the timing of, inflation and CPI and the prints and stuff like that.
Yeah, all
But the
right.
good thing about the
Okay.
July one is we're going to see the CPI like in the same week. We're going to CPI print. We're going to get the July rate announcement all in the same week.
Ooh, well, okay, so if you're talking about a consumer price index, right?
Yep,
When you say CPI?
that's right.
Yeah.
Yep.
So if the index is down, what's gonna happen? What do you think is gonna happen?
I think the lower rates.
Oh, yeah?
Yeah.
Um,
Some
hmm,
and honestly, I just don't think they're gaining anything by prolonging it anymore. And we get the opportunity in my world. Listen, I this certainly I like to sound smart, but a lot of I'm regurgitating what I hear from the economists. We get invited to a lot of the luncheons with the banks and are privy in some cases to sitting with their economists and listening to what they have to say. We had a good opportunity a couple weeks ago before the June rate announcement to sit with one of the economists from one of the banks, and even at that time, this was like 2 weeks before the announcement. I was like, I don't think they're going to raise it. And he was like, they're dropping it. Or I said, I didn't think they were going to drop it. And he's like, they're dropping it in June and they're dropping it in July. He's like, it's a done deal. Like he was so confident that it changed my opinion. And I was like, wow. So that I hear what he was saying. I mean, listen, he went into depth as to why, but I think I agree with what he's saying. It's abuse now for most Canadians. You can't, remember, we still have a large portion of mortgages coming up for renewal that are set to go from 2.5% up to like 6%, 5.5%, 6%. So inflation, it doesn't just stop going down. This will continue. Inflation, if we're right, if the economists are right, will continue to fall, potentially maybe under 2%, but it will continue to fall over the next 6 to 8 months, 6 to 12 months, and we want to be somewhere around 2%. We need to be. It's all about control, not to get too geopolitical, but it's all about control. We have to, as an economy, maintain a certain level of inflation and a certain level of growth. So the government will lower interest rates when they need to stimulate the market and get people out spending because we're facing a recession. They'll also increase interest rates to the point where they can stop people from spending to control inflation. So it's all about control. And now that noose has been tightened on most Canadians and their payments are going up or their rent's going up, or remember, the CPI comes down, but it's not like we get our prices back again. It's not like the
yeah, they're not gonna reduce the
knows
prices because the CPI came down.
That's right. They don't reduce. So combine the high prices with higher interest rates for most Canadians, and those that don't own homes, by the way, you're seeing most rents going up. I mean, I don't think rents are coming down, maybe in certain areas, but in high populated cities, you're certainly going to see rents continue to increase. So, there's trouble on the horizon and the government knows that. And that's why I think they're going to not necessarily take an aggressive approach. You can't drop it too quick either. What does your child do if you hand them a chocolate bar before dinner? They don't know how to control themselves. They're going to eat the chocolate bar. That's just how it works. So you can't lower interest rates because people will spend money. That's just what happens. If costs come down, even if people have paid off their credit cards, if costs come down, they go out and they spend the money again. That's the nature of human behavior for the most part. A very small people, you know, resist that urge. So you
Right.
have to control it slowly. You can't have this bouncing interest rate of and inflation going down and going up, because all that's going to do in the meantime, if you have that, remember, all you're doing in the midst of all this is destroying the middle class, and inevitably, you end up with the people with the asset. You end up with like Venezuela, where it's like 10%, or 90% poverty or something. It's crazy.
Well,
So
Yeah.
you
yeah,
need the middle
it's
class.
horrible.
The middle class is what runs the country. That's who spends money in the restaurants. That's who's buying, the houses. That's who's teaching in the schools. That's the middle class runs everything. So our government and our economy will always try to keep that And we do that by controlling inflation and controlling the cost of goods and controlling, on some level, wages.
Yeah,
Well, I was
they
gonna say,
also they can't drop it too fast, because if they drop it too fast, the house prices are going to go through the roof. Affordability is really rare now. If they dropped it too quickly, no one's going to own a home.
That's what I mean.
I know.
People will go out and spend the money, and they'll spend and they'll ring up their debt. And then if this happens again and inflation goes up again, then they'll have to raise rates, and we'll be in a similar situation that we were, the last couple of years, where affordability really comes into question. So it's sensitive.
Okay.
Listen, it's hard to. There's a saying, people will criticize the government for, dropping rates or leaving low for too long, but there's a saying that it's hard to judge, the triage doctor in the middle of the battlefield. So
Yeah.
they made decisions that they felt would keep the economy going, and they're going to make decisions that they feel will keep the economy going now. And I think that will include a slow drop in interest rates, but inevitably a drop in interest rates, which is what we want. I mean, I could see I think we'll see 1 to 2% by the end of next year.
Okay. All right. Good. All right. One more question before we close off here. Eva has asked, said, taking 50 years to pay a mortgage, does it not interfere in the profit considering the amount of interest you pay? Well, yes, over 50 years, you are going to pay a lot of interest.
Yeah. Yeah, you are. But it's a good question. So one answer is very, very lots of different levels. But one is the interest on the property is deductible. So you're getting the benefit of the write-off on that money. You're also getting the benefit of the lower monthly payment, which is going to help you with cash flow. So although it's interfering with the profit, it's also increasing the profit because you're going to make more on a cash flow perspective. And then obviously, listen, most people don't when you're locking into an amortization, it's really just a complement of the payment. Most people aren't sitting in that 50-year mortgage for 50 years. They're not taking a 30-year mortgage and sitting in it for 30 years. We readjust things. Amortization is more of a strategy than it is a reality, in a sense, because we're not taking, I mean, your likelihood of holding, and even if you own that property for 50 years, I think you'd be happy with the profit you made on it, and you'd be okay writing off the interest that you lost. 50 years owning a property, you make a
Totally.
pretty good return.
And at the end
Yeah.
of the day, right, it also comes down to the fact that 50 years, do it or don't do it, right? Because anything less may not be doable.
Yeah.
Yeah, that's true. That's very, very true. All right. Thank you, Daniel and Andrew, for joining us.